Hey, welcome back to Two Stupid Guys Trade Stocks. I'm Dylan.
And I'm Vinny. And holy crap, for those of you who are interested in sector rotation, this is the video. We're going to talk about why it matters, what sectors are rotating, and how your homeboy called it. And I want to show you evidence of that. Let's get to it. All right. So this background here is going to be like the main kind of chart, but we're going to talk about it here in a second. This is to show you this initial stages of the sector rotation and just like the massive outperformance that we've seen on a sector that no one pays attention to anymore, right? Or hadn't been for a while. This Russell 2000. Do you realize that this is how like egregious the outperformance of the last couple of weeks was? This was 5 trading days, but this was like last week
Yeah.
predominantly.
Well, Nvidia and Apple and AMD and all that, they all took a giant crap, which did not help. So yeah, they
Yeah,
killed it.
yeah, absolutely. I mean, you see negative returns on the Nasdaq actually in the sector. S&P 500, the gold standard for ETF driven in investing, had a gain, but a much smaller gain. And then you had Russell 2000, this conglomeration of companies no one ever pays attention to, but that are backbone of American economy, absolutely exploding here at like 11.5% gain in like a freaking week.
Yeah, it's a shit ton. It's got to be a record of some sort.
Yeah, so you remember this video back here? We published it May 11th. All right, this is when it went live in 18 reviews. But basically, my premise here was that we were on the impending edge of a sector rotation. Okay, this is the chart that shows historical valuation split between the large cap and small cap stocks. Okay, there's areas in the S&P 600 and S&P 500, but this is like a good representation of small cap versus large cap valuations. And we've been in this
Ooh.
kind of period of significant underperformance. All right, they say that the cycle tends to last 6 to 13 years, and or 6 to 12 years, and we're at like 13 years now. So it's been a little while that we're behind the ball. And the question is this represent like a coiled spring where it's ready to take off, or a balloon underwater, if you will, and the valuations catch up for these small cap stocks?
So
Thought.
does the bull phase also last 6 to 13 years?
Well, I mean, look at this prior bull phase where small caps had a premium in terms of valuation. It went from like
Yeah.
2004 to like 2018.
Okay.
That was quite a long run there. All
Fair
right.
enough.
Yeah, yeah, pretty crazy. When you talk about kind of figuring out your expected compound annual growth rate when you're looking at retirement predictions and stuff like that, something I do probably way too much, a little obsessively. But what number do you punch in for like your expected annual rate of return for the next like 30 years?
9.
You go 9%. A
Hmm.
lot of people use 7%, and then they also discount it from inflation. So people argue that the 7% is already discounting for inflation. People pick a lot of random numbers here, but the most commonly cited number for the compound annual growth rate of the SP 500 is this last 100-year number, about 10.6%, and that includes like dividend reinvested. All
Got
right.
it.
So if you look at this one, it says dividend reinvested and inflation adjusted, so 7.5% after that.
Okay.
All right.
Which is going to be worse now, but
Yeah. Okay. Yeah. I mean, that's a good thought. We can. That's a completely separate video topic. But historically, would you be surprised to learn this is actually the AI generated text when you Google this, which is kind of fun to use. Um, but small caps generated 2.5% greater returns on average on a yearly basis. Did you know that?
I did not know that. And also
Yeah.
that, I mean, looking at the previous chart, that would not have been true other than between 2004 and 2018. So 2018 to now, no, right?
I'm not sure on the time frame for this, but as far as I understand, it is as far back as data goes.
Yeah.
Because you get a lot of murky stuff where like the S&P 500 itself only exists in its current form since like 1954, I think it was. But some people go all the way back to like 1886 and the inception of like the stock market in the United States. Right. But it makes sense from a logical, intuitive position that it is easier to grow a small company. Right.
Right.
This is their logic for why. Um, Due to their higher growth rates, right? It's much easier if you only had $1 in revenue last year to grow at 100% and get $2 in revenue this year. That's basically what our channel does. They're domestic focused, they're largely U.S. biased. They don't have as much international exposure. Smaller size, same kind of thing. They're reiterating that you can grow faster when you're small. However, small caps can be riskier, more volatile, right? A lot of them fail, and people don't even know that they went out of business. They're not household names by far and away. Um, and then the large caps, and they may struggle in more high interest rate environments, right? Because small cap companies tend to be earlier stage companies, therefore less likely to have massive cash reserves, not less likely to be sustainably profitable, and more likely to have large amounts of debt on their balance sheet. And particularly when you have a high interest rate environment, that tends to hurt these companies, right? They're suffering from the burden of their debt, as opposed to like when you look at your Magnificent Seven, where they have massive hordes of cash and they're benefiting. They're now having, earning 5% return on their investment on in T-bills on for all these large Magnificent Seven companies, right?
I got a theoretical question for you. I'm gonna wait till the end. I don't want to throw you off.
Sure. So this is another kind of super investor that recently got credit for calling this a little bit. Stanley Druckenmiller. He was my understanding is it ran some money for George Soros. Is like actually one of the more kind of profitable and rich hedge fund guys as far as like self-made money, from my understanding. But on the most recent 13F filing, he actually had 15% in the Russell 2000 small cap ETF. So that was as of
50?
15,
Oh,
sorry,
okay. 50. Okay.
as of June 30th.
Man,
He's also credited with calling like a great bull run in Nvidia. So
that's a
he
awesome
plays
name.
both sides. Yeah,
That's a
yeah.
fantastic name.
Druckenmiller, yeah.
Yes.
Look at the this is kind of showing the outperformance here again too. We're looking at the SPY is up 0.3% in the last month, where you're looking at 8.5% on the Russell 2000. Still lagging behind significantly from all-time highs though, right? So over the last 5 years, only up 40%. That's less than half what the SPY has managed over the last 5 years, and we have still got quite a bit of room left to go back to this 2021 peak. All right. So there's a lot of like room left in this trade, I think, conceivably, is kind of my argument here. And as far as what triggered this, we're going to talk about that here in a second. But this is the 85% that the S&P 500 has returned over the last 5 years. Just a phenomenal run. But
And
are they going to be the best for the next 5 years?
I'm going to say no. I'm going to say also a huge factor here is, oh, here it is. Okay. Right.
How crowded the trade is? Yeah.
Huh? Yeah.
How crowded the trade is?
Yes.
Yeah. So this is another thing that kind of plays into sector rotation. This is a chart we've shown before. This is a survey of hedge fund managers asking what's the most crowded trades in the market right now. We've talked about this from like an Alibaba standpoint, being China bullish, but the long Magnificent Seven is the one that we're talking about here, and how the you saw triple Q and then SPY as a result also significantly underperformed the Russell 2000 over the last couple of weeks.
It's because literally, I think it's like 33% of the SPY, and I think it's 44-ish% of the Qs are 6 to 8 companies. So it's just crazy. I mean, those valuations, even Apple, which makes a ton of money, the PE ratio of Apple is historically significantly higher than it has been.
Yeah. For a company that barely has any revenue growth left at this point, yeah, I completely agree. That's why I actually let my shares from Apple get called away, and was used to buy, Russell 2000 ETF IWM.
How many do you have? How many shares of Russell do you have?
It's 99. I didn't have enough to get 100. They're like
Nice.
$220 a share, so it was like 20 something $1,000 position in that account alone.
Nice.
Yeah,
Oh, so you had a good week.
yeah, and I've also positioned as far as like household stuff. My wife's 401k, I have her half in a small cap ETF, and mine is I think 20% in a small cap ETF. I've
Wow.
been anticipating something like this, and like I said, I think it has a long way to go. What really triggered the thought process this week is just like another rumor, right? It's a data point came out, and now they're expecting a pivot, which is something we've talked about extensively. Everyone's always predicting the goddamn next pivot. But this was a CPI report that came out, all right, and we actually finally had a negative month-over-month change on the headline CPI number, which is what people got really excited about. It dropped to 0.1. So we actually had a negative number, 0.1%, and the headline CPI number hit 3%, down from 3.3% last month. Right? We can actually look at it line by line here if you want to see the full chart from the Bureau of Labor Statistics. So headline number was 3%. Core CPI was still 3.3. On a month-over-month basis, negative 0.1. Definitely a few negative numbers in here, which is always nice to see. Like, look at all these categories that are actually not having, declines in prices. Some of them already had been before, but you're starting to see more and more categories actually going into the negative
Right.
from a inflationary standpoint, which is cool to see. The Federal Reserve does prefer PCE as opposed to CPI, but CPI is always the one that gets the headlines. So That was the trigger for a lot of this event. And as that happened, you saw this, is the CME Fed Watch tool. They're now calling with a 94% certainty that we're going to get a rate cut in September. Pretty high
I,
degree of certainty, actually.
I agree with that one in terms of one rate cut. Maybe
Yeah,
September, November. I don't think we're gonna have two rate cuts. The 57.5% chance of two rate cuts by November, I do not think is gonna happen.
yeah, yeah. I get that. I mean, I had originally thought December meeting they were going to hold off until then, and we would only see that 25 basis point. So, as of last time, I would say I voted. I was right here in this crowd.
Yeah,
So,
I'm still kicking. Mine was September, November.
yeah, yeah. But that was really what drove this rotation this week is, if indeed rates are coming down, that's going to be similar to the American economy, right? Which is largely good for small cap companies. It's also going to be good from these companies from a standpoint of having decreased costs on their higher debt burden compared to the Magnificent Seven. So this could create some significant tailwinds for the Russell 2000. And you have this significant period of underperformance where it's almost, got some pent up energy or demand to it, and the hope is, that this will sustain for a period of time where we'll see the valuations flip. And now all of a sudden the Russell 2000 will have that premium valuation and their premium rate of return compared to the Magnificent Seven and, NASDAQ 100 and, S&P 500 overall, more in line with historical kind of ratios.
Okay, I'm gonna throw a question out. People are gonna stop watching by this point, but this is everyone thinks, hey, this time is different, right? We always think that, hey, this time's gonna be unique. Do you think that in the world of acquisitions, because a lot of the data is from 1920s and up or 1910 and up, right, where there's significantly more small businesses than there are large businesses, so therefore the Russell ETF data history is going to be different based on the environment today. Do you think the fact that the Qs and the SPY are 1/3 to almost half are 8 companies of the index, and the fact that we live in a time where you try to build a company that gets bought by Microsoft instead of becoming a Microsoft, do you think that will change the length of a bull run for Russell?
I mean, it's an interesting question. I would need to do a significant amount of like kind of research in order to have a, intelligent comment there.
That's fair.
It's
YouTube people,
possible.
answer.
Yeah, I know, right? Hell no, man! It's gonna be Russell 2K to the moon, bro. No, it's like 10x from here. That's the YouTube answer.
Well,
But it's a great question. I don't know. Obviously, you have a lot more scrutiny upon acquisitions from the federal government, from the Department of Justice
yeah,
standpoint. I don't know what effect that has had on the volume of these small transactions, because most of the acquisitions companies like Apple make are very, very small
yeah,
companies.
sure.
Um, and do you have this great walled garden because of the AI, the next adventure here, and whether or not you can afford the NVIDIA GPUs? Perhaps it does make it so that it's a larger company, winner take all environment. But what's to stop a small startup from having just the right people, the right team to develop like a market leading AI? It's totally possible.
Yeah, AMD 2012. All right, guys. Let us know what you think. Answer that question in the comments. That'll be interesting. Later.